Welcome to the Investing on the Go podcast. I'm Sam Slater, and today I've been joined by Richard Sennitt, manager of the Schroder Asian Income Fund. Hi, Richard.
Hi, everyone. Thanks for having me.
Perhaps you could start by telling us how Asian dividends are holding up at the moment. I believe the reporting season's nearly over, so we've perhaps got a better idea. And perhaps tell us whether there are any particular countries or sectors that have been doing better than others.
Let me give you perhaps a bit of colour on what's been happening to Asian dividends this year. I think, certainly after what you were saying about the sort of reporting season completing, I think it was perhaps surprising that during the recent results season, actually how few companies used the current crisis to actually cut their dividends. Now, this may have been driven by a motivation to either move cash upwards in the cases of sort of state-owned enterprises or SOEs, or indeed in family-controlled entities. But I think the key thing to recognise for Asia is that where actually Asian companies came into this crisis compared to some other regions of the world. So, for instance, if you look at payout ratios, the payout ratio in Asia prior to the crisis was around about 40 to 50% on average, and that compares with the UK at around about 60 to 70%. So lower than that of other markets. They're also less geared from a leverage perspective, and so with net gearing well below that of most other regions, what it has meant is that when profits have come under pressure because things have started to slow down, there's been a less of an immediate need to make wholesale cuts to dividends that perhaps we've seen in other markets. I also think that in places like the UK, I think perhaps some companies have perhaps used the crisis as a way to reset their dividend policies down to more sustainable levels. Anyway, all this I think has helped Asia in a relative sense versus other markets when it comes to dividends. One thing I should add is that Asia also looks to have suffered less than other regions when it comes to having dividends cancelled or curtailed due to regulatory pressure. And I think the obvious example that we think about when we think of that is the banks, where we didn't see the same pressure to cut that wholesale in places like Hong Kong and Singapore. Partly, I think this is down to the banks being extremely well capitalised. So they've got sort of core equity tier 1 ratios in their mid-teens in many cases. However, it's fair to say it's not the same across the region in the sense that it hasn't been totally consistent in that sense. And if you look at markets like New Zealand and Australia, there have been a bit more pressure from the regulator to curtail dividends, and indeed that's what we saw during the interim reporting season in Australia, where the banks there either cut or passed on their interim dividends. And I think in Australia's case, it's fair to say that the payout ratio in that market is more comparable to that of, say, the UK. So it is a higher level, and therefore, ultimately, I think there was perhaps a bit of extra risk, if you like, from a starting position, as there was perhaps in some other non-Asian markets. As far as what we're seeing in different countries or sectors, there is some variance, as you'd expect. A number of the REIT names have seen cuts in their distributions, for instance, such as in Singapore, and their rents were hit really particularly in the retail sector, as you can imagine, due to the lockdown there, or the circuit breaker, as they called it, has meant that profits have clearly been under pressure. And in a similar vein, gaming stocks in Macau also cut, which, given that travel was effectively stopped for much of the first half in China, again, shouldn't come as a complete surprise. However, on the flip side, I think positively, have been a number of companies, particularly in sort of Hong Kong, China, in property and the banking names that have either held or increased their dividends. And also amongst some of the tech names, this has also been a trend. So they've been pretty good with a number of names in Taiwan, for instance, either maintaining or increasing dividends.
And are there any areas that worry you particularly? I mean, some people have suggested that dividends have held up better at the moment because it's based on last year's profits, whereas obviously next year could be based on this year's profit. So is there any sort of area that you think might struggle next year?
Yeah, you're absolutely right. I think there's clearly one of the things which is very difficult to sort of get a feel for at this stage in the outlook for dividends is the sort of, if you like, the duration of the crisis that's occurred, in that, you know, whether we see a sort of a second wave coming out of either globally or regionally from a COVID perspective, and that could ultimately impact earnings for a longer period than I think people are expecting at the moment, and there's no doubt that ultimately, you know, earnings lead dividends, and one would expect dividend and earnings growth to be correlated in the medium to long term. However, I would say, all that said, when you go back and you look at other periods of stress for Asia, such as in the global financial crisis, that companies in Asia tried during that period to maintain their dividends, in spite of the fact that earnings were coming under pressure. And so in effect, they allowed their payout ratio to rise to substantially during that period to compensate for that falling profitability. Earnings during that period obviously subsequently recovered, and companies grew back into their sort of, if you like, their historic payout ratios. This could happen again, but if you remember back to 2008, 2009, actually from a sort of, certainly from an Asian perspective, it was a relatively short and sharp recession. And at the moment, what we don't have, if you like, is clarity on that sort of second wave that I mentioned. And, you know, we all sort of know that sort of alphabet soup of recoveries that we could get coming through. And until we get better clarity on that, you know, there is clearly going to be some risk to dividends. If you look at sort of consensus, currently consensus has dividends falling around about 15% this year. But I think, you know, what will be key, and we should get a bit more clarity about where dividends are going, would be around the sort of announcements, you know, the results announcement that we get coming out in sort of August. I think the final point I would say on this would be that although we are likely to see dividend cuts in aggregate, that actually dividends still look pretty attractive versus long bond yields and so on. And in fact, they're close to sort of highs on that measure, which in my view means that the market is already factoring in, if you like, cuts to dividends. And even if you were to see those dividends cuts coming through, actually the yields would still look pretty attractive versus bonds. And as we all know, that you don't get much yield on a yield out of bank accounts these days. So I think on that basis, I think income from equity markets could actually look increasingly attractive.
Thank you. And moving away from dividends just for a moment, we've obviously got the US election coming up, and both parties at the moment are actually quite anti-China. What are sort of the threats and opportunities for wider Asia, depending on the outcome of the US election?
Yeah, I guess geopolitics has been a sort of a major feature of sort of investing in Asia over the last couple of years. And obviously in the run-in, pre-COVID, if you like, we were all talking about sort of trade deals and whether we would get them or we wouldn't get them. And I don't think anything has really changed on that front. As you say, sort of, we've got an election coming up later in the US this year, and both parties are pretty united for once on one thing, and that is a sort of a distrust of China. And in that sense, I think that we are continue to hear. We're likely to continue to hear more and more noise with regard to sort of China sentiment. Still, given that, I mean, economic growth is clearly a very important factor to both the US. Certainly for Trump, he's sort of based his much of his presidency on making America great again. And he doesn't want that to sort of fall off the cliff. And equally, China's obviously wants to make sure that it continues to grow. And therefore, I think that they are, the phase one deal that we saw signed sort of at the end of last year, I think probably will continue to stand. But I think one of the areas that were going to remain sort of where tensions are going to remain high is going to be around technology and protection of IP, given China's desire to, if you like, to be number one in a lot of those high-tech areas. And you can see that through their sort of China 2025 program. Currently, one of the biggest battlegrounds is obviously 5G. We know that about sort of from whether we're going to allow Huawei in the UK to sort of build out those networks. It's obviously there's a lot of benefits to 5G. There's a lot of associated spin-offs, the Internet of Things, and all and so on. And Huawei, which of course is the vendor for a lot of these products, has been the focus, if you like, of the US, with yet more restrictions on companies being able to supply into them. All this, unfortunately, I think longer term means, in my view, that we are likely to see an increased bifurcation of the supply chain between Asia and the US. But I think that's not necessarily negative for Asian tech companies from Korea and Taiwan, as they actually supply into both chains. And ultimately, someone will have to produce this kit who the American companies the Asian companies will end up supplying to.
And leading on from that, I suppose that you almost answered my question already, but perhaps in a little bit more detail. One of your largest sector weightings in the fund is technology. So obviously you think the opportunities outweigh any of the potential threats from the US issues at the moment. What kind of technology companies are you invested in?
Yeah, so on tech companies, as you rightly pointed out, I do like a number of those names. I am overweight, and this is in particular in the hardware names, and I like their market positioning and attractive income properties. And just to be clear, I suppose what I'm not invested in within my income fund is the Chinese internet names, as these companies, rather like their Western counterparts, either don't pay a dividend or a de minimis one, and this is unlikely to change anytime soon. However, that's not true of the IT manufacturers that I own, and they are principally, as I sort of alluded to earlier, principally based in Taiwan and Korea, and they are the beneficiaries, I think, of a couple of interrelated themes, such as the increased long-term use of the internet, which is obviously seeing a continual build-out of data centers by the hyperscalers as more and more data is crunched online, things shift online and data shifts into the cloud. Also, they benefit from the increase in demand for communication products, driven by this whole shift to 5G and the Internet of Things. And key is that they tend to occupy leading positions in the areas that they operate, such as foundry, so the manufacture of semiconductor chips for others, and memory. They're also, from a balance sheet perspective, they're attractive. They've got strong balance sheets. They're very cash generative. And I think, what's been encouraging in this area is that many of them already had very good corporate governance, but a lot of others are starting to see that corporate governance improve, and those attractive payout policies, which ultimately mean that I remain overweight there.
The other area that you're overweight is real estate. Why is that?
Yeah, real estate, sort of the opposite. I suppose, as you say, a slightly different type of company. I like real estate for a number of reasons. I mean, the thing about the real estate that I like is mainly within the investment property names. So in the likes of Hong Kong and China, these are companies which trade at substantial discounts to their NAV, but are exposed still to very much to the ongoing growth of China. And through that ongoing growth in investment properties, in office and retail, they will continue to see over time their recurring incomes grow. And at the moment, there's relatively little of that is paid out in dividends. And I think over time, as that recurring income grows, I think that we'll increasingly see that higher levels of recurring income will be paid out to shareholders via dividends over time. So I like those companies for that reason.
That's great. Thank you very much. And if you'd like to find out more about the Schroder Asian Income Fund, please go to FundCalibre.com and don't forget to subscribe to the Investing on the Go podcast. Please note that these are unprecedented times and markets can react very quickly to news. The views expressed are at the time of recording and could change. Please remember we've been discussing individual stocks to bring investing to life for you. It's not a recommendation to buy or to sell. The fund may or may not still hold these stocks at the time of your listening.